So right now I'm using $7,000 gold, $200 silver, which I think are conservative. I think we're going higher than that. And I tell people, I said, look, I have a tool on my database and get an idea of what these companies are going to do. These things, the compounding goes absolutely bonkers. When
Right.
we get to $150 silver, every $10 it goes up, that stock could double. The
Yeah. Yeah. That is something that
compounding is
people don't get
nuts.
at
In my
all.
opinion, the only reason to own gold and silver miners, if you will, is if you don't believe in the US economy. Then Greenspan, then he started lowering rates. That was his signal that Greenspan put, was that he will lower rates to help to support the stock market. And it worked, and it created a massive bubble from 2001 to 2007, the housing bubble. He took interest rates down to 1%, created that housing bubble, and he printed, like crazy. His thesis was that the Depression shouldn't have ever happened. All they care is every month a 401k plan goes, okay, here, put in $100, put in $200. They go, buy. People don't realize how cheap these companies are trading at. I mean, it's
Yeah.
literally pennies on the dollar. I mean, these are stocks that could be five baggers in 18 months. If silver prices, if gold goes to $6,000, I mean, 1911 gold, if you just do the math on it, they're going to be about a 45. They're going to go into production Q4 this year. So they're going to ramp up Q1 of next year about 45,000 ounces. So if they're producing 45,000 ounces and then gold goes from today, it's at 4,000 and goes to 6,000, which I think is possible next year. And you just put a 10 multiple on it, it prints out as a five bagger in 18 months.
Yeah.
And that's phase one, 45,000 ounces, phase one. Then they have another deposit to add to that, 500,000 ounce deposit, about 8 grams that they can add, take it to 60 to 70,000 ounces. And then I think they're eventually going to get to 80 to 100,000 ounces. So 1911 is kind of crazy cheap. And then Jaguar Mining, another undervalued producer that's growing production. They have three mills. One mill is not even being used on care and maintenance. The other two mills are being used at half capacity. There's organic growth. All they're going to be doing is basically filling these mills up. And they've been having really good success with exploration. And I like their team. I like the CEO. So those are my five. And I can go on and on. You guys can go to YouTube. About a week ago, I did 50 buy the dip stocks.
Markets celebrate expensive momentum while ignoring producers trading at fractions of their potential value. Don Durrett notes that expanding production into a stronger gold environment changes valuation far faster than most discounted cash flow models assume. Wall Street often waits for confirmation, leaving early upside to patient investors willing to accept uncertainty. Missing this phase can mean paying multiples later instead of discounts today. Next, Don Durrett reveals why institutional screens systematically overlook tomorrow's biggest mining re-ratings.
And so these five are on it, and then there's another 45 for you guys to check out.
And I would just add, if people aren't a sub of Don's, he has a great website called goldstockdata.com, and you can fact check all 50 of those, where he gives you about a 3 paragraph write up on the stock, but also a ton of metrics. And Don, when you're putting those metrics in, you're modeling at a certain price for gold and silver, correct?
Yeah, so there's three ways to invest. The first way to invest is the long-term capital appreciation on an annual basis. You're trying to get 5 to 20% every year. Just
Right.
steady as you go, 20, 30, 40 years, just steady as you go, right? That doesn't really work well for gold and silver miners. It's just too speculative. It's too much volatility. Just look this year, right?
True.
If you added money in January, it's like a lot of people, like every January they like add more to it, right? If you would have added money in January, your portfolio, your gold and silver would have got absolutely obliterated. And so it doesn't really work well for the long-term capital appreciation because it's more speculative. This is the reason why Wall Street isn't interested in gold and silver miners, because they're doing this long-term capital appreciation. And so that's the reason why you saw Agnico Eagle, which is the elite of the elite, go down from $250 to about 135 this year,
Yeah.
because Wall Street doesn't care if it's valuable.
A quality miner can lose nearly half its value even while its long-term fundamentals remain intact. According to Don Durrett, traditional buy and hold investing often clashes with the extreme cycles that define precious metals equities. The disconnect explains why institutional capital frequently exits precisely when long-term value is improving beneath the surface. Investors who mistake volatility for permanent impairment risk abandoning their strongest opportunities. Next, Don Durrett exposes why Wall Street's favorite investing strategy repeatedly fails inside mining cycles.
I mean, it should be traded. I think maybe it bounced, maybe it's back to about 150, but I think it went all the way to 135,
It's
which
about
is
145.
now it's at 145, and it was at
Yeah.
250. In
Yeah.
January, it's at 250. This is a company, it's the elite of the elite in Wall Street. And this is the reason why, is because of what I just explained. It doesn't really work. Gold miners don't really work with a capital appreciation strategy. And that is the main strategy that people use. You mentioned earlier, John, that you can't find nobody wants to invest now. And that's the reason why they don't want to catch falling knives. They don't want to get out in front of the steamroller. They only want to chase momentum. They want to have confidence that they're going to make money, basically.
Yeah.
So strategy one doesn't work well. And most people are used to strategy one. That's how they've invested their whole lives. Strategy
True.
number two works for gold and silver miners, and that's a big chunk of people that do it. And that strategy number two is having a short-term focus, but you want to have outsized returns. So those are the people that show up like they want annual returns, they want capital appreciation, but they're okay with stepping outside the box when they see some momentum. They see a sector doing well, oil's doing well, gold's doing well, commodities doing well, the tech stocks are doing well. They'll see it doing well and they'll like, okay, I'm going to go grab some of that.
Momentum usually arrives only after the largest gains have already been captured by earlier buyers. What Don Durrett is highlighting is that capital consistently chases performance instead of anticipating value, creating repeated boom and bust entry points. Institutions prefer confirmation because career risk matters more than buying cheaply. Retail investors copying that behavior often end up paying premium prices for yesterday's opportunity. Next, Don Durrett unravels why conviction consistently outperforms perfect market timing.
Right? It's kind of outsized returns, but it's a short-term focus. I consider those people like they want to have like a 50 to 100% return, but they want it now, right? Now, the third way to do this is how I do it. I don't care about the next 12 months. I don't care about the near term. And the reason why I don't care about it is because I'm speculating on a thesis. And my thesis is that gold's going higher. Now, I don't know when. It could do it in 3 months, right? But I'm very confident. We're going to get into this. We're going to talk about macro. But
Yeah.
I'm very confident that in the next 36 months, gold's going to be significantly higher than it is now, potentially double where it's at now. And
Wow.
so I use a future price. I look out into the future about 3 years, 3 to 5 years, but usually around 3 years. And I say, okay, what's gold going to be at? And I constantly adjust those prices because I'm always focused on, I don't care about the next 24 months. I'm looking at 36, 48, 60 months. So in my database, on my website, I'm constantly adjusting the gold amount that I'm using to value these miners. So today I told you about Silverco, Denarius, Talisker, 1911 Jaguar. Those
Yeah.
picks that I like, I could be wrong. You never know, right? In gold and silver, we're speculating. Those picks are all based on a 36-month focus, 36 to 60 months, with gold prices silver prices going up substantially.
The market obsesses over quarterly earnings while monetary cycles unfold across several years. Don Durrett's argument suggests that valuing miners with today's prices ignores the future environment those assets are actually being built for. That difference explains why consensus models frequently underestimate major commodity bull markets. Investors anchored to current conditions may miss the biggest wealth transfers entirely. Next, Don Durrett reveals how future metal prices completely reshape mining valuations.
So right now I'm using $7,000 gold, $200 silver, which I think are conservative. I think we're going higher than that. And I tell people, I said, look, I have a tool on my database. You can plug in whatever future gold price you want. You can plug in their future production and use a lot of variations. So I tell people, don't just use 7,000, use 7,500, use 8,000. Don't just use 200, use 150, 200, 250, 300, and get an idea of what these companies are going to do. potentially going to do. Because what's going to happen is a lot of people are going to sell early. They're not going to anticipate gold going to 7,500 or silver going to 250. And they don't realize the upside because these things, the compounding goes absolutely bonkers. When
Right.
we get to $150 silver, every $10 it goes up, that stock could double. The
Yeah, yeah, that is something that
compounding is
people don't get
nuts.
at all. So, Don, let's move on to macro. You just talked a little bit about gold. If you want to talk about gold and silver, or you want to talk about some of the factors that are driving things right now, we can.
In my
Most investors underestimate how non-linear mining returns become once metal prices cross key thresholds. This is where Don Durrett's thesis shifts from stock picking towards scenario analysis, where small commodity moves create outsized equity revaluations. Institutions routinely model multiple price paths, while retail investors fixate on today's spot price. That difference shapes who captures exponential gains and who exits too early. Next, Don Durrett exposes the hidden assumptions quietly embedded inside conventional valuation models.
opinion, the only reason to own gold and silver miners, if you will, is if you don't believe in the US economy. If you believe in the US economy, you really feel confident that everything's just going to keep going, everything's fine, stable, don't worry about it, then don't get into gold and silver miners. I don't believe. I really believe that belief is important because of the volatility. Remember, I said that, we've had this correction, this 36% correction since January, and it hasn't bothered me. The reason why it hasn't bothered me is because of my conviction slash belief that gold's going to end up being the winner. Now,
Right.
if you look, I look at history. So one of the reasons why, so I was 20 years old in 1980, and that's when Reagan came into office. And so I've lived, so I went to college in the 1980s during the Reagan period. So I experienced the pivot into globalism, the pivot into basically money printing. And I experienced the Greenspan put in 1987. So the Greenspan put was, we basically went down 22% in October 87. And Greenspan came out the next day and said, don't you guys worry about the stock market. I got your back. I'll print whatever's needed. Stock market immediately turned around and went up. From that day forward, they call it the Greenspan put. Don't worry about the stock market. The Fed basically said, Greenspan said, don't worry, the stock market goes down, I'll do whatever it takes to get it back up. and and
Yeah.
and then we didn't have any problems until 2001.
Every rescue today quietly increases tomorrow's financial vulnerability instead of eliminating it. Don Durrett notes that decades of intervention conditioned investors to expect central banks to suppress every major market decline. That expectation changes risk behavior far more than interest rates themselves ever could. Savers relying on perpetual rescues may discover those guarantees disappear when confidence matters most. Next, Don Durrett reveals why the Greenspan era permanently altered investor psychology.
And then Greenspan, then he started lowering rates. That was his signal, that Greenspan put, was that he will lower rates to help to support the stock market. And it worked, and it created a massive bubble from 2001 to 2007, the housing bubble. He took interest rates down to 1%, created that housing bubble, and he printed, like crazy. And
Yeah.
then, everything, and then we had the great financial crisis. Well, that's basically the Greenspan crisis, from basically taking rates too low to put too much, which is what we've done ever since. Basically, bubble, bubble, bubble. We basically been living on bubbles. So Greenspan, he told us, and he was in office from 87 to 2006, and he pretty much told us what he was going to do. I'm going to lower rates and print money, and don't worry, everything's fine, right? And he got away with it because we didn't have any inflation during his era. From 87 to 2006, there was no inflation. So the Greenspan put was absolutely in place, but he also set a precedent. This is the reason why you want to own gold. He basically set a precedent that the Fed would manipulate and manage the economy. Forget about free markets. We're not using free markets here, people. We're using the Greenspan put, right? And then Bernanke comes in. Now, isn't Bernanke a really interesting guy to come after Greenspan? If you
Hmm.
think about it, he was in love with the Bernanke put. Greenspan, Bernanke, he wrote his thesis.
Policies that postpone pain often compound the eventual cost for long-term savers. According to Don Durrett, repeated intervention transformed temporary market corrections into progressively larger financial imbalances over time. Cheap money rewarded leverage while quietly eroding the purchasing power of disciplined investors. Preserving wealth increasingly depends on recognizing policy incentives instead of trusting comforting narratives. Next, Don Durrett exposes the historical pattern connecting easy money with hard landings.
His thesis was that the Depression shouldn't have ever happened, that all they needed to do was print money and they could have avoided it. It was a liquidity problem, right? Which is exactly what the Greenspan put is. And so Greenspan comes in 2006. He's ready to print like crazy, which is what he did. Basically took rates to zero, which is the Greenspan thing, right? Use rates and use printing. So Greenspan really was the guy that really destroyed the U.S. economy because he rug pulled the free market, and then
Kind of like
Bernanke.
Mario Draghi in Europe.
It was a very similar thing, very similar. And then Bernanke came in and said, "Don't worry, I got your back. I'm Greenspan on steroids. Don't you worry." And they built those two guys together with a tag team that destroyed the U.S. economy. But and if you can see it, if you have eyes to see, if you do the research and you look at what's really happened from 1987 till now, you can actually go to 1980 or you can go to Nixon in 71 when he took us off the gold standard. If you really look and see, the only thing that's keeping the U.S. the stock market up right now, it's twofold. First thing is passive investing. So we got 60% of the stock market is passive investors. It's all passive funds that just keep coming in. Now, passive funds, they don't care what the stock market's doing.
Markets can stay elevated long after price discovery quietly stops functioning as intended. What Don Durrett is highlighting is that passive investment flows increasingly support valuations regardless of underlying fundamentals. That creates the appearance of stability while concentrating systemic risk beneath the surface. Investors assuming constant liquidity may discover it disappears exactly when everyone heads for the exit. Next, Don Durrett unravels why passive investing could amplify the next major downturn.
All they care is every month a 401k plan goes, okay, here, put in $100, put in $200. They go, buy, 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 buy. They never sell. All they do is
Yeah.
buy. And so when you got 60% buyers, no, they're not sellers, they're only buyers. And when you put that in tandem, right? So we got all the passive investors, the 401ks, pension funds as well. When you have that many passive, when you put that in tandem with the US government, with this fiscal dominance where they're basically borrowing 2 trillion. So we have 5 trillion in income, 7 trillion in payouts. So 2 trillion deficit, right? So all that money is being basically shoved into the economy. So you got the passive economy, and then you got the stimulus from them. Then you got the Fed in the background going, "Don't you guys worry. You need anything? We'll pump up the volume." Warsh comes into office and he says, "Oh, I'm going to go after that. I'm going to go after that inflation. Inflation is my number one priority."
True.
Look at the Fed's balance sheet since he came in. With the Fed, if the Fed's balance sheet is increasing, that means they're printing money. So the Fed's like, no, there's inflation. They don't care about inflation. They're printing money. And Warsh actually even said that he's basically Milton Friedman. It's a monetary issue. When you print money, you create inflation. When you expand the money supply, you create inflation.
The inflation story weakens whenever money creation quietly continues behind reassuring public statements. Don Durrett's argument suggests that expanding deficits and central bank liquidity deserve more attention than headline policy speeches. Markets respond to actual capital flows, not carefully crafted press conferences. Investors ignoring that distinction risk protecting narratives instead of protecting purchasing power. Next, Don Durrett reveals the contradiction between anti-inflation rhetoric and ongoing monetary expansion.
The Fed's been ignoring Friedman forever. They don't even talk about the money supply. Now, Warsh said we got to start talking about the money supply. Bottom line is this: is that our economy 71, 87, 2006, it broke. And gold's going to be the winner. Now, look at the US dollar. Since 1971, the dollar's dropped 86%. Since 1971, 86%. So the stock market is at what if you look at the numbers, it looks like it's doing fantastic, right? But now value it in gold. It's down 86%.
Right.
So it's broken. And that's the reason why I own gold and miners, because it's just, people say, well, this thing is never going to break because of the passive income. But 20% of that money in the stock market today is foreign money. That foreign money, that's the risk here, is if we ever do go into a recession, people say, well, we're never going to go into a recession. But if we do go into a recession, that foreign money is going to leave. And when the foreign money leaves, because the foreign money is only here to make money. They're like, oh, let's rotate out. Stock market's down 10%, 15%. We got to rotate out. Foreign money starts leaving. And then at that point, the passive money turns. There is nobody backstopping the passive money. Nobody. So if the passive money turns and says, I want to sell, there's no buyers. It's too damn big. It's too damn big. With 60%, I mean, these funds are just uber massive. So if they decide to sell, there's nobody on the other side. And then you have the derivatives.
Yeah.
It's a house of cards.
A market dominated by automatic buyers can become surprisingly fragile when capital reverses direction. This is where Don Durrett's thesis shifts from inflation toward liquidity, because selling pressure matters most when natural buyers disappear. Foreign capital and passive flows can reinforce each other until confidence suddenly breaks. Investors should watch liquidity just as closely as earnings or valuations.